Why do we need to invest? Yeah, financial freedom. What if you don't invest? Let's say, for the argument's sake, okay, you manage to save £100,000 or dollars, and then you got really decent size of savings. And what if you keep it without investing? What's going to happen to your little money pot? Exactly. Inflation is the single powerful word, right? Even though we don't like it, I know government and everybody is trying to bring it down, but it's there. Unfortunately, like all you rightly said, if you keep your savings in a bank account or anywhere without investing, the inflation is going to bite into it. So that shiny car or property or anything, right, you could buy with your money today, right, it's not going to be affordable. Or why do you have to be smart? Yeah, not lots of money, right? Yeah, you got to manage your risk, right? You don't want to go invest somewhere randomly and wake up next morning and see it's gone, right? So you got to be smart and also know your risk. Taking risk is not a bad thing, right? Because higher the risk, higher the reward, right? So if you want to get higher reward for your investment, of course you have to take higher risk. So taking risk is good, but having that control, right, knowing what you are doing is important. If I talk about the risk a little bit, right, comparing bonds and stocks, right, which one is more riskier? So you don't know basically, right? You cannot predict the future. There are ways you can predict, but you don't know exactly what's going to happen, right? Whether it's going up or down. We all hope that it will go up so that you can cash in your investment in the future. But yes, what about bonds? Yeah, it is. Yeah, government or could be corporate companies like Tesco. If they want to expand, open up 10 more shops, what they do is they issue new stocks or shares so that they can finance. Yeah. Why is it less riskier compared to stocks? Stocks, I'm sure you all know that, right? So company, I don't know, Goldman Sachs or Tesco. So you can go and buy little fraction of ownership of the company by paying certain amount, right? That's the market value. So if you go and do a Google search, what's the current price of Tesco, right? It might be £2, £10, whatever. It changes over the time, every minute, every second, right? So that's the stock. So we talk that the stocks or the shares, in other words, are a little riskier compared to bonds, right? Bonds are the ones issued by mainly governments or corporate companies, or could be any other institutions, right? When they want to raise money, basically business, right? They want to expand and they want to finance. And one way of financing, getting more money is to go and talk to a bank. But corporate companies, they are very smart, right? They don't want to talk to a bank and arrange a loan and pay higher interest rate. What they want to do is, right, get people who are interested in investing them, right? Give us money. In return, we will share the future success with you. So we agreed that bonds are less riskier than stocks. And I heard that, it's because issued by established institutions, US Treasury bills or the bonds. They are very established. Yes, it carries a little risk, but if US Treasury, right, goes bust, and then the capitalism as we know, right, that's the end of the capitalism or the current markets. So even though it's riskier, less risk. But there is another reason why bonds are less riskier. It's because the contract is written on the paper, right? Beforehand, before buying, that you are going to get this amount much of coupon. Coupon is the interest rate, right? So let's say for the bond you buy, the UK government is going to give you, I don't know, 0.75, or if it's a corporate company, it could be higher. Or if it's emerging market, which carries, high risk, like if you want to invest in blooming Asian markets, the interest rate is higher. However, it's written on the paper, right? As long as the company or the institution, right, stays afloat, which means at the end of the contract, right, it's still in business, they will pay you the original amount you invested and the interest you earn. That's written in the contract. So that's why it's less risky. That's another thing, which is index funds, right? I'm sure you heard, right? There are a lot of index funds, and one popular one is S&P 500, which is US based. The reason is you are not tied into one single company. You know that Tesla, right? Nvidia, or those tech companies, Google, they are very exciting, right? So the price is higher and the reward is higher as well. So they always, well, not always, but most of the time, keep going up and up and up. But what if, for the argument's sake, a crash happens, like what happened in 2000, right? .com crash. The bubble was building up and up and up, right? Everybody was getting into internet, and then it crashed. So what if that happens? Your value of investment or the share price goes down. However, the difference of investing in index funds is it's tied to a whole index. So S&P, 500, as you can guess, it tracks the biggest 500 corporates in the US, right? So your risk and the growth is kind of, standardized, because you are not exposed to one company or one area or one industry. It's big and vast. Because of that, the risk is lower. That's great place if you want, invest with a less or low risk index funds.